Hi, everyone. Thank you for joining today. My name is Erin Stafford, and I manage the North American CMBS team for DBRS Morningstar. And joining me today, I have Kurt Paula, Managing Director within the North American CMBS team at DBRS Morningstar. And also we have Troy Dahl, Counsel at Alston and Bird, and should note, former ratings analyst as well. Today, what we'd like to do is talk to you about the bifurcation of ownership interests in commercial real estate, specifically leasehold transactions. And there's really been a long history of financing with leasehold transactions. But over time, as we move throughout cycles, things tend to shift. And we thought this would be timely to take a look at some of the things that we're seeing specifically as it relates to leasehold transactions and some of the structural protections and or things that identify credit risk that, in particular, that you may find in CMBS transactions. So with that, maybe what we could do, since we're throwing around terms leasehold, lease fee, and things like that, why don't I kick it over, Troy, to you to just give us a basic introduction to the ownership rights and the terms that we'll hear throughout today's call and what those mean.
Okay, thank you, Erin. Thank you for inviting me to be here today. I appreciate it. Leasehold financing, there's really two distinct ways to go about it, or two distinct types of financing that go with it. There's the quote unquote leased fee financing that we talk about in the industry a lot, or we call it that in the industry, where you're really just mortgaging a fee interest that then is ground leased to another entity in its entirety. We'll try not to use the term lease fee, even though it's an industry thing, because it really is commercial real estate is leased, and it's what we do with it. That's the fee estate in the property, and we'll try and refer to it as that. The other area that we're going to spend a lot of time talking about today, I think, is leasehold financing. So here's where your mortgage is actually on the lease. And if you foreclose, you take over the lease. You still have a fee subject to it, but you then become the tenant in the lease. So you have more limited rights, and there's more precautions that you have to take. And with that, I'll hand it over to Kurt to talk about some of the issues that go with this.
Yeah, I guess, Kurt, as you think about that, in my introduction, I talked about the fact that this isn't new, right? We've seen this for a long time. So historically speaking, when are the circumstances that we've run into leaseholds?
Well, as you've said, they've been around quite a while. They've been in CMBS. Troy and I being sort of the grizzled veterans, I've seen this for going back. And Erin, you've been in ratings for quite a long time to see it too. And yeah, traditionally, what you've seen in the way of leasehold financing hasn't really raised too many red flags, because for the most part, you'd see a fairly modest portion of that ground lease payment be as a percentage of your EGI and your expenses, and so you wouldn't see any kind of enormous or anticipating sort of an enormous stress being put on your leasehold interest. Now, we've had, of course, these really high profile exceptions, which is in our New York City, where you have these market resets where really nobody, when these ground leases were drafted and executed, could have imagined the extreme appreciation in land value. But that also speaks to the thing we do pay attention to, we'll get to later, which is these ground lease terms are 50 to 100 years, give or take, depending on the state and the initial term plus extensions. And so what you're looking at is a really long span of time that your leasehold improvements are supporting these ground rent payments. And the issue that we really focused in on over the past several years has been the ability of those leasehold improvements to be able to withstand the even just a constant sort of CPI adjusted ground lease payment, let alone so these well publicized market resets. They're going on right now. And so that, and fee interest we still see and are very strong, right? I mean, you can see why they're highly sought after as an investment, because they've just been known as a very steady, stable, reliable source of income, very bond-like, and they have performed really well. I mean, you really in CMBS don't really ever think about the leasehold owner defaulting and you getting the property back. That, however, has changed, and that's what we're gonna talk about a bit more.
Yeah, and I guess as you mentioned, we've seen these a long time. Historically really long dated, 50 to 100 years. How has that changed? Maybe in the last 10 years, have you seen like newly executed ground leases? And do those look different than maybe what we've seen in the past?
They, I would say yes, they do. And I had kind of stepped away from CMBS, from ratings for a while. And when I came back in 2018, and kind of got back into, okay, what's going on, and seeing what was the current sort of the trends that were occurring in capital markets. What I think we began to see was, just to boil it down to this basic terms, more value being extracted from the ground, and the value, I mean, which is partly just the value appreciation that was occurring there in some primary market cities like New York. But you were reaching a point where you started to ask yourself, are the ground rent payments, are they too large? I mean, maybe not right now, they don't look like it, but again, we're looking at even within a 10-year time frame, those payments increasing, and depending on your asset, on your property type, you're going to go through cycles, right? And that's something we've had to be more mindful of. But I think what you're also seeing, and this is not any secret, I think you've seen more activity within the business of explicitly going to a property owner and pitching the opportunity, the economic opportunity of splitting the fee and the leasehold interests, and how that's beneficial to the property owner. And so you're seeing that sort of that's a relatively new occurrence, where it's this opportunistic the ability to split the fee and the leasehold interest. And there is some amount of type of arbitrage there, as far as the benefits to the property owner of just becoming the leasehold position and selling off that ground lease interest, which again, I think is very attractive to a lot of investors for its traditional stability. And I think that is something that's slowly, gradually over the last, say, 5 years or so, we've seen more of. And we're also, as we'll talk about, because of this pandemic and granted some of the activity is extreme, seeing the fallout of what happens with a ground lease agreement when your leasehold improvements get into trouble.
Yeah, and I think we'll get to that, because we've got some really good examples, and which is kind of actually the purpose of why we wanted to have this call in the first place, was to talk about some of these things in more detail. Troy, as we think about the leasehold and the long dated ground lease, maybe can we talk about when you get into a situation where you might have a wasting asset, and Kurt, weigh in on this as well.
Sure. Well, I mean, there's a few instances where you could have a wasting asset. Some of them are things you really can't do a whole lot legally, and the number one is when your term expires. there's only, with a leasehold interest, you only have the property for a set number of years. As those years dwindle, there's less long-term value. There's less time to recuperate the costs. More of a problem with a balloon refinancing and the maturity date refinancing than with your current term. An area where you have a big issue with your current term, and again, not too much you can do on the legal side, but something that needs to be taken in on the credit side, is when you have a market rate or rental increase, a rental rate reset, let's say, because there's a couple of different ways it can be done. One is there's a set rent step, which you can take into account in credit. Okay, the rents are going to go up. The expenses for the property are going to go up this much at that point. How much is the income going to go up? If it's a fixed rate, you at least know your expenses. You don't know the income. So that needs to be taken into account. Where you've got a market rate or something tied to market rate rental increase is more worrisome in a way, because you don't know what that new market rate is. And if it goes 100% to market, well, that value of your ground lease can be significantly reduced, which is a problem not just for refinancing, but also debt service coverage on a day-to-day basis and month to month. A couple other areas where we do try and address things legally is it's a wasted asset if the lease goes away because of a default. So when we talk about structuring, we'll talk about how we address that, how we make sure that the lender gets notice and cure rights with it, but also addressing the wasting asset part. It's really crucial that we structure the loan documents and our ground lessor estoppel so that the leasehold mortgagee or the leasehold lender has the right to exercise any extension terms. Because you have these ground leases, they might be 99 years plus 20 years or something like that. If you can extend those and you can extend them, then you can include that 20 years into your value for the asset.
Right. And I know, just real quick, we will, for everybody listening, we will get to questions at the end. But Kurt, I think we've seen a recent example of where we've had significant loss on some improvements. Do you want to walk us through one of those?
Yes. Well, and the thing about it is we've been planning to put a piece out. We've been working on it for a while, and the thing we found is, I think it's not coincidentally, is that we've seen just more and more activity in especially service leasehold mortgages in particular, but even some stress on the ground lease fee side that's occurring that probably some folks would never have imagined before. And so we had a growing number of examples to choose from. We tried to be fair about it. I think the one we'll talk about that maybe is on people's radar that happened pretty recently, November 2020, is an extreme example. But nevertheless, it's kind of gives you the sort of the end all be all of what can happen. And so it's 545 Madison Avenue. And the ground lease had already been in place and was the ground lessor was a real estate family. And the purchaser of the leasehold improvements, office building in the Plaza District of Midtown Manhattan, office space plus retail, which back in 2014, this is a JP Morgan Barclays 2014 C8, $30 million mortgage on the leasehold interest. And it was an opportunistic acquisition whereby the plan was to unlock the value in the lower below market rents, both the office and the retail. And in fact, the acquisition itself was I believe one that was due to stress that had occurred with the prior owner who'd put a lot of money into improving the asset and basically reskinning it, redoing it inside and out. Well, unfortunately, it didn't work out. right? And yes, the pandemic was sort of the final blow to that because it really wasn't performing as expected before 2020. And basically, what happened was that the borrower walked away, and then the property was reappraised by the special servicer, and that was determined to be, unfortunately, because of the increase in the ground lease burden, which I will tell you was large to begin with, unusually large, 47, almost 48% of the property's EGI in 2014. Now that was also because, again, there was upside potential in the rental income that was kind of assumed, and that the ground rent payment would become a much smaller percentage and a much smaller burden on the leasehold owner. Again, that didn't work out. So unfortunately, when everything just completely unraveled, including the ground lease agreement, right? And it was sold at a virtually 100% loss. And the winner was the family that was the owner of the ground. They got back the property, and they'd actually apparently owned the ground lease unencumbered. And so they were left with a very well renovated property and no debt burden, and worked out well for them, but definitely a bad experience for CMBS. Again, more on the extreme side of the spectrum, because honestly, we don't see ground rent payments being that much of a significant of an expense burden day one.
What is the normal percentage that you do see?
And I know we've had that question, right? And it's there's no hard and fast rule. I'd say asset specific. It's something we look at just on every leasehold that we might look at. And we found, though, if I were to give a number, if you're approaching day one, or even during the term of the leasehold loan, about 20%, around that range. Certainly, if we see it, like I said, traditionally, I'd probably say it was more in the range of single digit, low double digit percentage of your EGI for those ground rent payments, which left a lot of room for stress that might occur with the leasehold in the way of declining rental revenue. I think that's maybe a segue into the stress that we are seeing, right? Which is what you would expect. It's the hotels, like the operating assets, where they're subject to a lot more cyclicality potentially in their rent during a cycle. And when you have a fixed to, well, basically, if it's not fixed, it increases over CPI or some fixed percentage. With that kind of burden on an operating asset, it as it's having right now, has the effect of, again, in the extreme case, just completely unwinding the entire ground lease agreement. And we're seeing that kind of stress, and it's high profile. I was just pulling up the most recent news on the Hilton Times Square. I think that's probably, if anybody's heard of that, of any stress, that's a big example of even a ground lease interest in a CMBS transaction potentially facing a loss, because the value of the improvements they've decreased so much that you don't know what your recovery is going to be.
Right. One of the things too, Kurt, that you mentioned earlier was kind of the sum of the parts, right? And do they equal the whole, right? So I think the interesting thing, when we look at the lease fee versus the leasehold, and a lot of times in CMBS, when we have the leasehold interest, right? We don't always know if the leased fee is encumbered or not encumbered, but looking at, in totality, one would expect that, any debt potentially would equal, like, as if you had just, the property in full on the asset, those two, 1 + 1 = 2 versus 1 + 1 = 3. I think one of the things that we had looked at was, just the underlying of the appraisals that we're getting on the leasehold themselves, and what is or isn't being differentiated for potentially having that significant amount of payment going outside of the collateral value to the ground leaseholder. So anything there that you're seeing, or how we're looking at that internally and taking that into consideration in the credit?
Yeah, it's a variety of things we've seen, and I think we'll also touch upon some of the legal aspects of what we need to, has been a hot button issue that Troy can talk about. I think we also had questions about, which were kind of more of a black and white type questions than how we maybe look at things. And that is that we do a look-through analysis on these, right? Period. We look at it as fee simple. That's our starting point. And that's on the ground lease side. And that's also how they're looked at from the market. So the market looks at the fee simple interest and says, look, this is our ground lease payment compared to the values, because you're assuming that you get the leasehold improvements back. If a tenant defaults, you're evicting them and getting a new tenant. And that makes sense. But then the issue becomes, well, what about when we see the two separated, and what does that leasehold ownership interest appraise out to? And we're a rating agency, so in general we are, obviously, as people know, can be more conservative on our values, and we're rating through cycles, and we might have a different view on what that is than the pure market view. But it is something we really scrutinize when we see the leasehold value and how the appraiser is or is not, in our view, really accounting for the risk of the ground lease payment. Whether that's, sure, they're looking at the lease and they're looking at the payment stream and what that's going to be. But then they're also assuming, in some cases, a healthy amount of growth from rental, from the revenue coming in, right? So that would just offset that. And again, and looking sort of our look-through opinion of the value, those aren't going to match up. And then furthermore, maybe we're going to have a difference of view on what that cap rate is that the appraiser is applying to the leasehold value to really properly account for the risk, other than the fact that we know we have some sort of a ground rent payment schedule that we know that they're going to be subject to, and that's where we've really spent a lot more time. And I think the question also is to, okay, is there some sort of real breaking point of what we think is too much of a burden for the leasehold interest to carry as far as the ground rent burden? And again, I sort of gave the rule of thumb there, but it is on the rating side, when we've seen some of these recently, it's not a question of rateability per se, because yes, we have an extreme case where you actually, in not even a AAA type scenario, get wiped out on the leasehold side. And that's why we've been really focused on, as the starting point, the look through, and that's a look through, by the way, without the ground rent in there, right? Just to be simple. And then we look at what that burden is, and we decide, okay, do we think this is really something that in perpetuity can be, it is going to be okay, or it's going to put the value and therefore the trust in jeopardy? And,
right. So
and as
it may be a situation where perhaps you don't get the highest investment grade proceeds for that loan.
Yeah, that's a possibility. Also, I mean, we haven't seen, at least not that I can think of in the last few years, leaseholds that have kind of pushed the boundaries that we've talked about to where we've struggled to say, gosh, do we really even think that this should be effectively tranched up past whatever your expected case is, and you know, what type of expected loss should be assigned to a loan like this, other than definitely higher than normal, right? Because the risk is there. Now we're seeing actual evidence of what can happen in a real stressed environment that leads us to really be that much more cautious.
Right. Let's talk about the big wild card, I guess. And Troy, you mentioned it earlier, right? It's the market rate reset versus CPI and how those get determined, when they get determined, right? I think, you know, we, in our little prep call we had yesterday, we specifically talked about, like, if you had a market rate reset in 2019 and you're the lease fee owner, you're feeling pretty good. If you had, you know, but then you're not feeling good if you're the leasehold and in 2020, the property performance is down and you just had a market rate reset tied to 2019 values. And these don't happen every year, right? Market rate resets are kind of meant to be the catch up in a 50 or 100-year type of a ground lease. So I guess, Troy, maybe like from what you see on the legal side, like how do these get finalized? Are there more specifics now in some of these ground leases, or is it ambiguous, like so that we'd have to go to court for some type of arbitration? What are you seeing there?
Well, I say probably the best thing is that the rental increases are pretty far out, so that, you know, most of the parties are looking at, okay, we can finance this, and, you know, whether amortized or not, get the deal done and paid off before you have to worry about, you know, the rental rate increase. You certainly have seen the problem in some instances where the step ups in rents, whether they be fixed or whether they be CPI or market rate, you know, eats away most of the value of the lease. I think one of the things we spoke about, Chrysler Building, is definitely one of those. But when you have that step up, you don't have the certainty of, you know, where it is. It makes it very difficult. You might be subject to an arbitration proceeding. Usually lease arbitration proceedings are quote unquote baseball style, where it tries to force the parties to agree before they end up with an arbitrator or gets them closer to it. But unless you've got a market rate reset that's well below what the market is, then, you know, you're probably got a wasting asset that doesn't have a lot of excess value for the leasehold.
Yeah, and Kurt, how do you, as you know, as we're looking to assign ratings with that potential, how do we get comfortable
with market rates resets? Well, I don't. I mean,
or we don't.
Yeah. Well, I think. Well, first of all, I think we're seeing a trend towards fewer of those. If they already, I mean, well, barring the ones that have already been put in place and existed for years, I think the market is going to hopefully learn some lessons from this, as are we, which is as the market resets are. It's looking way into the future, and we don't have a crystal ball. We can't really know what that's going to be, although that kind of leaves at this point being that much more conservative on what a reset might look like and how we should adjust our ratings accordingly. Again, getting back to, okay, was it a wasting asset, which is not something you want to call the piece of real estate, and you don't want to be in that position, certainly as the leasehold owner. But you get into really just an untenable situation as far as how you deal with those types of resets. And one of the things that that Troy and I talked about, which we can touch upon, which is it doesn't seem palatable for the ground lessor to ever want to significantly modify a ground lease agreement to deal with the changes in the market that occur over these longer periods of time. And that in itself is a problem. I mean, because you get into these situations where that we're already in with some of these leasehold loans in CMBS, where one of the only solutions would be, hey, can I renegotiate the ground lease? I mean, that's what's happening in the Chrysler building that Zambi Rosen, I believe, they purchased it, and they're trying to see if they can renegotiate a ground lease that's been in place for 100 years or more prior to the Chrysler building with the Cooper Union School, and that's tough to do. And there doesn't seem to be an appetite for that. And because of that, I think the market's going to continue to shy away from these market resets and just stick with something more like the CPI or just fixed increases. What we're seeing, I think, more of with recently executed ground leases. But it's a good question as far as, and it's situational. If we want to see a market reset with a hotel or a retail right now, not be good, because that gets into the whole issue that we've been talking about, which is the possibility of a longer term obsolescence of the leasehold improvements. Mm. And their inability to really cover the ground rent payment, because it just becomes uneconomical.
Right. With that, Troy, maybe we could get into just some other structural things that you're looking for when we are seeing the leasehold, even whether lender perspective or obviously credit perspective, things that you want to see to kind of ensure some of these protections against things that we're talking about.
Sure. I think there's a few things. Kurt and I were talking a little bit about it before the call. Whenever we do these, I think anybody that's familiar with ground leases, you always see the ground lease reps in your mortgage agreement. And we always want to make sure a key document with any time you're financing a leasehold interest is to make sure you get a ground lessor estoppel, or as we'll often refer to it in our loan documents when I'm representing a lender, as a ground lessor estoppel and agreement. And the key there is that there's some things that maybe the original ground lease doesn't cover that we need to try and fix up. But I'm going to step back, because the first thing we want to make sure you do with this is you want to make sure you know what your collateral is. So the first line of any estoppel is attach the ground lease to it, attach all the amendments, make sure the ground lessor tells you this is everything that's there. Because if there's other agreements between the ground lessor and your borrower, the ground lessee, and you don't know about them, you can't really analyze what your collateral is. So the first thing is to make sure you know what you've got. And then once you know what you have, you want to go through it and see, what else needs to be done. Where are the things that would make this, I never want to say non-financeable, but sometimes it is, non-financeable. Number one, you definitely want to make sure that they can't amend it without your rights, without your consent as the lender, so that, what you have in place stays in place. You need to make sure that you have notice and cure provisions, because if your ground lessee borrower defaults under the lease, you want to be able to fix that, to cure that before the ground lessor evicts your tenant and you're left with nothing. Usually, we look to different monetary versus non-monetary cure rights and make sure that the lender has the right to, if they need to, foreclose on the ground lessee, take over and fix something that they wouldn't be able to do otherwise. Really key with that. Plenty of other topics that you can go through with it. A big one that we always speak about is getting a new lease. If the lease does get terminated, and this is particularly important in a bankruptcy, because in a bankruptcy, it's not something you can cure. It's not something that the lease can be rejected. And I use the term rejected specifically because if it's rejected, depending on which bankruptcy court you're in and which bankruptcy judge you might have, it doesn't mean it was terminated. So if it's rejected, you want to be able to get a new lease on the same terms and agreements. And basically just really protecting yourself from the risk of losing the asset. Because while we can talk about a wasting asset, the lease gets rejected in bankruptcy or the lease gets terminated and the tenant evicted. If you don't have that new lease provision, you've got nothing. So, there's some other provisions in there that we're making sure we're getting, but those are really some of the big ticket items for that.
And what about the flip side? If you're the least fee, I know we started out saying we weren't going to say that, but if you're in the other position.
If you have the least fee, and this is another reason why I'll say the least fee is commercial real estate is meant to be leased. And if you have a fee interest and you're leasing it, it's really not that different from a property with a credit tenant or really any subset of tenants. It's better than a credit tenant one in a lot of ways, because if you foreclose, you've still got the other income coming in from it. You want to make sure the lease is in place. You want to make sure that income stream is solid. But overall, it's not that different from your regular, commercial mortgage loan. One thing we had spoken about while we were talking about earlier is if there's, affiliates between them, you want to make sure that there's appropriate merger clauses so that your estates don't merge and create difficulties. I've never seen that happen, but it's something that we make sure is in all of our documents so that it doesn't happen. And really, you'd like to have a mortgage on, both if they are affiliates, because there's different concerns, but you don't see it very often. So long story short, from a legal perspective, the quote unquote leased fee financing is much simpler than the leasehold financing. Many, many less risks.
Great. I think one final question, Kurt, that I had for you was just surrounding, if you do see the leasehold in a CMBS transaction, what is the length of the ground lease that you'd like to see?
Right.
And if you're short of that, anything that can mitigate?
Yeah, it's been kind of a hard line drawn in the sand there, as far as seems the industry standard has more or less been the kind of at least a 20-year tail because of the refinanceability risk, and or it's, I think, 10 years past the amortization term if there's amortization. There's nothing better than good old-fashioned amortization to mitigate that risk. And as we all know, we've seen less and less of that across the board in lending right now. And while I can understand it being okay on the more on the lease fee side, which again is really, lease fee loans have generally been 10 years in length and not had a lot of amortization because it's short term compared to like a very long lease term, and assuming that you have the tail, the 20-year, the 20-year tail there on the lease fee side. But the problem has been refinanceability on those, as far as our rising interest rates and not being able to refinance into a new mortgage that has the same economics as you had before, and therefore, because your ground rent payment's not adjusting to your mortgage payment, right? It is what it is. And I think on the lease fee side, that there's nothing better than having amortization to try and mitigate that refinanceability risk. And is it because as you know, like as you get closer, you get to the end of the ground lease term, the more you're really just what you're doing is you're doing a PV of your cash flow that you're getting on the leasehold interest, and because it's going to stop at whatever year that is, and you're going to hand the property back, presumably back to the ground lessor, and that's that. And that's why it's really important to mitigate the risk in these with either, I mean, they're going to be lower LTV anyway, because I think we have seen that to account for that risk, just not fully levering up that leasehold interest. But on top of that, it's prudent to have amortization on those too.
And one thing I want to add with that is when you're looking at that, you're often taking into account the extension terms. That's one of the things, back to what I said before, making sure that the lender can exercise those extension terms, number one. Number two, making sure there's not a huge, market rate or other rent step in connection with those rental terms, so that you actually have value during them.
Right. Well, I know we received, prior to the call, we received a lot of transaction-specific type of questions. So those probably are more case by case and would need to follow up individually with those questions. But I guess, Kurt or Troy, any closing comments at this point? Or
well, from my side, I'm going to say, I just want to make the point that we're not saying that fee leasehold bifurcation is a bad thing. It's not. If it's done, I think appropriately, and again, you sort of look at the equation that we talk about, which is just the parts equaling the whole. Then I think it's fine to have leaseholds in CMBS. But if you start to really push the limits there to the expense of the leasehold ownership interest, then that can be a problem, whether it's tomorrow or 10 years from now, depending on the property type, where in the cycle we are, and because we have. Again, we've seen this happening right now in real time during the pandemic. It's just something to keep in mind again as that we're looking at and that investors should think about. And that's just the big picture point I wanted to make.
I'd say one thing that I would just add is that while it is very difficult, I mean, there's definitely some key economic issues, and some of those economic issues are not anything we're going to be able to address legally. A lot of times, some of the legal issues are things that we can address. It's why I mentioned before the ground lessor estoppel and agreement. And you might have to go back into negotiations with your fee owner, ground lessor, to fix up some of the things that are not financeable in today's market. You have those older ground leases, and although the term may have partially expired anyway, they might still have a long ways to run. But a lot of the legal issues that we've thought about, we've seen happen, weren't in place when a 1970 ground lease was originated. And that lease might still have 50 years to run. So it'd be financeable, but you have to go back and get the literal carbon copies and review them and go, okay, we need to change this, this, and this. And that can be significant negotiations, and the lessor might be amenable to it. They might not be. or more likely they might be amenable to it at a cost. And it's something that, you know, borrowers and lenders need to be aware of when they start entering into these things and looking to do ground lease financing.
Great, thank you. We did get a question in regarding private transactions, and obviously not at liberty to comment about private transactions, but in general, what I'll say, you know, when we're differentiating something that might achieve the highest, you know, credit quality ratings, AAA or AA, versus something that might cap out in the single A category, a lot of times that's structural in nature and just lack of structural features. So, you know, there is the view that we rate to, you know, timely payments of interest and principal, and sometimes things that we're asked to look at don't have provisions for that, and so that will end up potentially capping ratings. So you do see that from time to time in private and public transactions. So I just wanted to make mention of that. I'll check one more time. I think that's all that we had. So thank you, Troy, so very much for jumping in and participating on this. The legal perspective, I think, is definitely helpful. It's a little bit complex, and there obviously are things to look at differently than, you know, the traditional mortgages that we see in CMBS. And then also, Kurt, thank you as well for all those on the call. Kurt's research piece will be coming out shortly, and we'll again touch on a lot of the things that we talked about in the call. So we appreciate your participation. Thank you so much.
Thank you, Aaron.
Thank you.